All right, let's talk about Liberty Energy. Their latest earnings report just dropped, and it was a fascinating one. On the surface, it looked like a miss, but the stock, it went on an absolute tear. So we're going to dig in and figure out exactly what happened. So here's the puzzle, right? You look at the headline numbers, and Liberty missed on both earnings and revenue. I mean, basic math tells you the stock should have taken a hit, but it did the exact opposite.
And we're not talking about a small bump. The stock rocketed up over 28% in a single day. Look, whenever you see that kind of move on what looks like bad news, you just know there's a much bigger story going on, one that the headlines completely missed.
So the big question is, what did the market see? What was the hidden detail that sent this thing flying? Well, it all boils down to a massive, and I mean massive, strategic pivot. Okay, first things first, let's look behind that headline miss. We've got to start with their core business, the oil and gas completions. Getting those wells ready to pump. And yeah, that part of the business is definitely facing some headwinds right now. So, the hard numbers. Revenue landed at $947 million, and they posted an adjusted loss of 6 cents a share. I mean, there's no sugarcoating it. Those numbers point to a real slowdown in their bread and butter operations. It was a tough quarter for sure. But, and this is a huge but, while the financials looked weak, the operational story was something else entirely. They were hitting record pumping efficiency, they rolled out a new AI platform called Forge, and you had management on the call saying this market softness is just transitory. And then came the real kicker. They raised the dividend by 13% in the middle of a downturn. Okay, see that dividend hike? That wasn't just a small move. It was a massive signal. It's the clue that leads us directly to the real story here, the reason for that 28% pop. And spoiler alert, it has almost nothing to do with their traditional fracking business. It's all about power. So what does that mean? Liberty is jumping head first into on-site power generation. Think about it like this. They're building and running dedicated power plants fired by natural gas right on their customers' property. We're talking about customers like huge AI data centers that are incredibly power hungry and just can't rely on our aging electrical grid. And the scale here, it's just mind-boggling. They're aiming for 500 megawatts of capacity by the end of 2026, and then they plan to double that to over a gigawatt by the end of 2027. Just to put that into perspective, 1 gigawatt is enough electricity to power hundreds of thousands of homes. Yeah, this is not a side hustle. And the demand? It's absolutely exploding. You had the CEO, Ron Gusk, on the call saying their sales pipeline has more than doubled in just the last 90 days. And he said the urgency from customers has increased meaningfully. This isn't Liberty pushing a product. This is the market pulling a desperately needed solution from them. Now look, these aren't simple deals you close overnight. This is a complex, long-cycle sale. You've got to identify land, get permits, lock down a fuel source, and then get that final customer commitment. But what smart investors saw was that Liberty has a clear, step-by-step plan to lock in these huge, long-term revenue streams. All right, so how does all of this new power business play into their forward look? This is really where the market put 2 and 2 together and saw the much, much bigger picture. And this is the perfect way to think about the new Liberty story. You've got 2 completely different businesses under one roof now. On one side, you have the old school completions business. It's cyclical, it's in a temporary trough. But on the other side, you have this brand new power business riding a massive secular growth wave, all thanks to AI and electrification. We're talking about contracts that are 15 years or longer. That's stable, predictable revenue. So let's circle all the way back to that dividend hike. It makes perfect sense now, doesn't it? Why would you raise your dividend during a downturn in your core business? It was a signal. It was management screaming from the rooftops that they are absolutely supremely confident about the future cash flow that's coming from both the eventual recovery in completions and this explosive new power business. Okay, so now that we've unpacked the whole story, here's our official take from us here at Talk Tickers. Let's get into the rating and where we think the stock is headed. Plain and simple, we're rating this an outperform. That 28% jump, that wasn't an overreaction. That was the market waking up and doing a fundamental reevaluation of what this company is actually becoming. Our outperform thesis really rests on 3 key pillars. First, the stock is being re-rated.
It's shedding that cyclical oil service label and becoming a secular energy infrastructure growth story. Second, that 1 gigawatt power target, that's basically a huge call option on the entire AI revolution. And third, their operational excellence and that bold dividend hike prove this management team is not only skilled, but also totally committed to its shareholders. So the bottom line is this: the whole story, the entire narrative around this stock has shifted. Nobody cares about the frac cycle drag anymore. The conversation is now all about the incredible optionality on on-site power. That's the new game.
All right, to wrap things up, let's talk about a potential trade idea. Now, just to be clear, this isn't advice, it's more of a thought experiment, how you might express this thesis if you were, say, pitching it to an investment committee. We're calling the idea the power optionality trade. The core thesis is that even after that huge jump, the market still hasn't fully priced in what happens when they announce their first major data center contract. So how do you play that? You could consider long-dated call options to really capture that potential upside when a big announcement hits. Of course, there are risks. Any delays in signing those power contracts, or if the frac downturn gets even worse, that could definitely challenge the thesis. And remember, this is not financial advice.